It's interesting to note that the gold bull market didn't end when the price of gold dropped 50%. There was an eightfold move in 6 years, from $100 an ounce to $850 an ounce. The people who were scared off missed it. Okay, it's a test of who you are. Oh, but that's on the way. Do not mistake. When silver acts out like it is now, I think you'll see a huge move that will blow your mind in the next couple of quarters since that spread breakout. It's not going to happen in steps. You are going to a new world, and I don't think it would surprise me if it was in several hundred years. Gold and silver aren't just going up right now. Things that have held them back for decades are breaking them free. Gold is still being stored by central banks. The world's debt keeps growing, and industries are using up silver faster than supply can keep up with demand. That's why Rick Rule and Michael Oliver are telling people who invest in precious metals very seriously. This isn't a short-term upward trend. It has to do with a structural shift that has usually caused huge price swings and sudden repricing. You're not ready if you're hoping for a smooth ride. We need to look at how real bull markets work and why volatility is not the bad thing that most buyers think it is in order to understand what's really going to happen. In the 5 years since we last talked, 30-1 of the posts on social media about uranium were bad. Okay, that's the best it gets. I don't see anything that's hated right now, but there's a lot of hate. That's too bad. I kind of agree with what you said. I believe we are currently experiencing a bull market in rare metals that will last for a very long time. One that will remind me of when I first started working in the business in the 1970s. We've been beaten so badly since then that it will take the top off our imaginations. Also, I believe it's been 2 years since the last big commodities bull market. I think that for now, we have to deal with maybe lower material prices because the world economy is growing less quickly. Based on production shortfalls, the very low oil price and the relatively low copper price tell me that we're having a hard time moving this stuff. But I think that problem is starting to get better. I believe that supply shortfalls will be bigger than possible demand shortages as well. I believe there will be 2 bull markets. When it comes to chance risk to reward, I still think the oil and gas business is the most dangerous. Oh yeah, for all the reasons I told you about the last time we met. But if you think that the price of gold today will stay that way, which I do, then yes, there will be ugly drops from time to time. But if you think that gold's long-term trend is steady or up, then I don't think gold stocks are too expensive. Certainly, they cost more now than they did 18 months ago, but at $4,200 gold, the net present value of those companies' free cash flows is a lot more than it was at $2,500 gold. To be more specific, I did net present value calculations on Agnico Eagle at the last 3 conferences where they were an exhibitor. According to my method, the stock is cheaper now that it has doubled than it was before it doubled because the net present values are higher. Another thing your listeners should pay attention to is that we will continue to get good earnings shocks. Here are some of the reasons for that. And yes, even though Wall Street and Bay Street planners usually talk about $5 to $6,000 gold, the analysts are using $3,200 in their earnings predictions. If your prediction is that gold will be worth $3,200, then you are selling it for $4,200. It's hard not to be surprised by your wages. So, I think that the bigger names, the bigger producers, and some of the middle producers will continue to have positive earning supplies shocks, which will be good for everyone. That's a very happy note. When you talk to a guy my age who has been in the market as long as I have, I always have to give the opposite view. I do this even though I think gold prices will go up, probably by a lot over the next 10 years. I am sure that the price will drop by 25 or 30% at some point. I think people should learn about history. Gold went from $35 to $850 during the bull market of the 1970s. A great run. In 1975, in the middle of that, the price of gold dropped by half, and gold stocks dropped even more. Because of this, speculators need to prepare mentally and financially for unpredictability. It's interesting to note that the gold bull market didn't end when the price of gold dropped by 50%. Some people who were scared missed a move from $100 an ounce to $850 an ounce, 8 times in just 6 years. Clears throat. Oh, it's a test of character. Oh, but that's on the way. Do not mistake. Rather than hype, Rick Rule's message to people who invest in gold and silver is based on history. It is important for buyers to remember that even the strongest bull markets don't move in straight lines. Gold fell by almost 50% in the 1970s, right in the middle of its bull run. A lot of people thought the move was over and sold. They didn't just miss gains, they also missed a rise of 8 times what they had expected. The decline did not end the market's rise. It put faith to the test. Rule says that the same thing is happening now. Gold is going up because of structural forces, not speculation. Increasing global debt, lessening fiscal control, devaluing currencies, and central banks buying more and more are not short-term trends. They are long-term forces that cause prices to change for financial goods over time. Rule always tells investors not to mistake fluctuations for failure because of this. He thinks that sharp drops, even ones of 25 to 30%, are common in long-term bull markets. They get rid of weak hands without changing the trend that's already going on. In this situation, volatility means that things are changing, not breaking down. When it comes to silver, though, the change is much more noticeable. Michael Oliver says that silver is more than just a metal that is tied to gold as money. It is also an important industry material. Solar energy, gadgets, electric cars, and data infrastructure have all been using more than what is available for years. The persistent shortfall has been hidden by the way silver has been priced, which has kept it in a long-term range. Oliver's most important idea is not based on numbers or headlines, but on how things compare to each other. When the price of silver rises above long-term resistance levels compared to gold, the move that follows is not slow. It's going off. From 1979 to 1980, this took place. It did it again from 2010 to 2011. After years of disappointment, silver prices went up a lot in just a few months in both cases. Oliver says that the same structure break has already happened again. A multi-year high point in silver's performance has been broken, which means a regime change and not just a usual rally. When markets break out of long-term bands, they often go too far as prices adjust to facts that were hidden for years. Rule and Oliver agree on one very important thing. You won't feel good in this time. The changes will be very clear. Things will move quickly. There will be wild swings in confidence. However, markets act in that way when they are adjusting to a new reality instead of responding to short-term feelings. It's not possible to buy and sell silver the way you used to. And gold isn't reacting to the same assumptions that investors used to believe for decades. Now we come to the most important question investors need to ask as the next step starts. With gold, silver goes up and down. It has worth that goes up and down, and you can draw a chart of it. And our way is a little different. It's not something we do. That's what we do. It takes 1 ounce of silver to split 1 ounce of gold, which gives us 80%. You can also go back more than 50 years, say to 1975. And plot what the best reading for silver was at the end of the month that year compared to gold. This is what we did. Okay, when silver was going through its bull market in 1979 and 1980, it was still trading in the $4 to $50 range. For example, silver went up 4.5 times in 5 months during the 1980s, when it reached $50 for the first time. This was part of a longer-term bull market for both silver and gold. Okay. What caused the silver bull trend that was already going strong to go off the charts and dramatically change the course of events that no one saw coming? Okay, silver had been going up with gold for years before 2010 and 2011. It was a stacked type of gold that was going up, which was frustrating for the bulls, but still going up. Then all of a sudden, from September 2010 to April 2011, or 6 or 7 months, the price of silver doubled. In September 2010, it was around 20 degrees. It went back to 50 all of a sudden, like bam, bam, bam. It did that for years ahead of time. In the last few quarters, all of a sudden it went crazy again and stopped at the top of the old range, which is now 50 years. Was a range of 50 years. What made that bomb go off? Shouldn't it have gone up to those high points the same way it had been going up? What made it go crazy? If you look at the difference between silver and gold at that time, you'll see what looks like a ceiling. That spread chart is what I'm going to talk about now. You draw the difference every month. B. During that bull market for silver and gold, there was something like a shallow cap that kept silver from going above a certain level compared to gold. It popped up above it all of a sudden. That would have been in the summer of 2000 or 1979. And when it did, the price of silver went crazy and over 4 times what it was before. Then it was September 2010, and the price was already going up. Silver was worth $20. Also, that spread went through a ceiling that anyone who draws charts could see if they did it the way we do. And boom, it doubled in half in 7 months. It did happen again, but this time it was even more clear on the spread chart. Even a bigger base that goes from silver to gold over 10 years. That percentage of silver to gold couldn't go above that level, and at the end of November, it did. Bam. Silver goes crazy all of a sudden. There are times when markets are stuck in a band for many years, or even decades. This happens in a lot of other markets as well. Copper prices did this. In the 1970s, they were between 50 cents and $150. From the 1980s to the 1990s and up to 2005. In late 2005, it broke out above that range and went to 450 cents in just a few quarters. Bam, 50 to 450 bucks by itself. It wasn't linked to other based metals, for instance. It did it by itself, had nothing to do with what gold and silver were doing at the time. Lead did the same thing after a year and a half. You could draw a lead chart from many years ago, and it would still be in the same place it was in. When it broke through that in a few quarters, the price dropped by 4 times. All of them were squished into a couple of quarters. Once more, it wasn't connected to the copper move by itself. So, we've seen these kinds of things happen in other markets, where prices have been the same for so long that you can't believe it. It's getting old to you. You believe that living forever is the truth. It doesn't. And when the market adjusts to a new reality, it does so quickly and in an exaggerated way. We see bubble tops in the stock market, for example, and a lot of people think, wow, I should have known that. It turned out to be a pretty dramatic fall after that. When the NASDAQ 100 fell 82% in 2 years, it completely wiped out the dot-com bubble. The same thing happened from 2007 to 2009. The point is that when a market has done something wrong, either too much on the upside or too much on the downside, as in this case for silver caught in a 50-year range, when you look at every other market in the world, copper, lead, and gold, they weren't caught in that 50-year range. Copper's range was 50 cents to $1.50. The 450 floor is where it lives. It's now about 5 o'clock, almost 6. When you stay stuck in that kind of range, but silver stayed in that range for 50 years, even though copper broke out of its range in 2005, lead in 2007, and gold would far exceed its previous high in each of its bull markets. You know, it was 850 in 1980, then it went down to 1920, and now it's 4,000, etc., because some banks may have been playing a game with the central banks to try to keep it low for some reason. In the end, that didn't work. Okay? But when silver goes off like it is now, I think you'll see a huge move that will blow your mind in the next couple of quarters since that spread breakout. It's not going to happen in steps. You are going to a new world, and I don't think it would surprise me if it was in several hundred years. Rick Rule's advice is easy to understand. Do not let instability pull you out of a long-term trend. The message from Michael Oliver is stronger. It's rude for markets to move when long-term peaks break. They accuse you of being rude. There is no talk about gold and silver. They're reacting to the fact that debt, supply problems, monetary stress, and a crash in industry demand are all happening at the same time. Now let me ask you the real question. Do you think that the price of silver is about to change? Or do you think this cycle will end like the last ones? Type your thoughts in the space below. And make sure you turn on notifications if you want clear analysis based on signals instead of noise or news. This cycle will punish people who don't understand and praise people who do. The biggest mistake people make when markets change reality is they think nothing has changed.